The Federal Reserve is going to meet very, very soon, and something historic will happen. We will see how the interest rate gets lowered, probably by 0.5 percentage point. Because this is what the futures market is anticipating. We are currently at a target rate of 5.25 to 5.5%. And there is an almost 70% likelihood that we will go down by 50 basis points. Now, why does this matter? It matters because it has a direct impact on all kinds of investments. Fundamentally, any investment works in a way that we give cash flow away today in order to get future cash flows later on in time. And we have to discount those future cash flows. As in, if we get a very high risk-free rate by just buying US government bonds, we have to discount those future cash flows more. If we don't get that much free rate, then we have to discount them less. So the value of any investment is the sum of its future cash flows discounted to the present value today. And so that mechanism explains then charts like this. This is a long-term US government bond ETF. And once the market started anticipating that interest rates might fall, the future cash flows have to be discounted less. Thus, the present value of those future cash flows goes up. Thus, the price of those long-term government bonds go up. Thus, this long-term government bond ETF went up by 24%. And that's over the course of less than 5 months. The longer the duration of an investment, like a government bond, or let's say like a tech stock, the more we have to discount the future cash flows, the more interest rate sensitivity we have. So when interest rates go down, the value goes up and vice versa. Now the Nasdaq also went up since April. But the Nasdaq is a reflection of growth stocks, and growth stocks have the vast majority of their value far out in the future because the cash flows grow over time. And so this is the Nasdaq divided by that long-term government bond ETF. It actually went down. In other words, all the gains that we have seen in tech stocks in the last month were due to the Federal Reserve. They were all due to expectations of interest rates going down. They had nothing to do with the technology companies themselves. The cash flow expectations of those companies actually went down. This needs to go to 1 million, or March buyers now will make millions. This is how you get the clicks on YouTube, but this is not how you beat the market. To beat the market in crypto, you need to be better informed than the rest. You need to be better skilled than the rest. You need to do better blockchain analytics. You need to track other people's wallets and know what is the smart money doing. It's the boring educational content that forms skill that doesn't perform so well on YouTube though. That's why I created the premium membership. Feel free to check it out. We are tracking influencer wallets to find out what they are buying before promoting this on YouTube. We've got a lot of tutorials to help with on-chain analytics, to help with wallet discovery. And of course, there are also plenty of chats where we help each other, and also one-on-one conversations with me. So I'm messaging every premium member one-on-one directly. Once you're joining, you will get a message from me and you have the opportunity to directly pick my brain. Feel free to check it out, thebitcointrader.com. Link is down below. And so all of this is interesting because markets are interconnected, right? There is a direct impact of interest rates on, for example, the property market. There is the indirect effect of valuations on tech stocks due to the interest rates. There is also potentially a spillover effect to crypto markets. Because even though the correlation isn't very strict, if we just look at this in terms of monthly returns, we might have a loose connection. As in, if we just look at the monthly return of the Nasdaq 100 relative to the monthly return of Bitcoin, we tend to see high correlation. So let me show you what I mean. At the top, we've got the Nasdaq 100. At the bottom, we've got the correlation coefficient of the Nasdaq 100 relative to Bitcoin. And at first glance, it looks like there is not a lot of correlation, right? We seem to be trending between -1 and +1. It's just oscillating back and forth. This doesn't really tell us that the assets move in the same direction at the same time, right? If we've got high correlation and the two assets move in the same direction, we should be close to 1 over here. So high correlation simply means this, right? Everything goes up at the same time, but also things tend to go down at the same time. But if we have things that aren't highly correlated to one another, we can potentially own this in one portfolio and protect ourselves against a crash in one of those asset classes. And so this looks like the Nasdaq 100 is a good protection against Bitcoin crashes. However, when we look at the monthly returns, then the picture isn't necessarily that clear. It appears as if the correlation coefficient gets closer to 1. In other words, the two assets don't really move in sync with one another, but if we zoom out, if we hold both over many months, we might get similar returns. However, this is not true for long-term government bonds. And so that's why I like to look at the interest rate development. Because at the top, we've got Bitcoin. At the bottom, we've got the correlation coefficient to long-term government bonds. It also oscillates between +1 and -1. And even if we zoom out, right, even if we take the weekly returns or we take the monthly returns, we don't really see any kind of clear correlation. And so owning some long-term government bonds is a pretty nice isolated play to protect ourselves. If we see more and more interest rate cutting, we are likely going to see continued appreciation of those long-term bonds. And they outperformed tech stocks, they outperformed Bitcoin, they outperformed gold, they outperformed everything. And here is what the market is currently pricing in. The market thinks that 1 year from now, we will have an interest rate between 2.75 and 3%. So we're going down by 1.5% over the course of the next year. Financing property will be cheaper. Future cash flows of tech stocks have to be discounted less. The monetary base is likely going to expand as well. And so the only question is, what asset will benefit most from that? The asset that's probably going to benefit least is simply fiat cash, right? Fiat will get devalued versus the monetary base over the next year. That's pretty certain. And so I'm simply holding everything. I hold different asset classes with different weights. I am not that heavily into Bitcoin right now. I am somewhat heavy though into those long-term government bonds. I also like precious metals because historically they're pretty cheap relative to stocks. I do not like things like Nvidia because, in case you don't know, 14% of all of US M2 is now equal to the valuation of Nvidia. At the peak of the dot-com bubble, Cisco was the most expensive stock, and that was 12% of all of US money supply. So even though Cisco at the time had a lot of demand, and even though Nvidia now has a lot of demand for the GPUs, there might be a bit of exuberance in the market, and I'm simply just careful. Why should I be in that much technology stock risk if long-term bonds even outperformed over the last 4 to 5 months? But I know this take is controversial, so I'm looking forward to your arguments. I'm looking forward to actually make a video on those comments. So please comment down below. I want to discuss all arguments to continue to get risk on. And of course, if it's your first time here, feel free to subscribe and feel free to give this a like as well. It helps the channel grow. In case you've got Telegram, feel free to join us. There's a link to our Telegram down below. Looking very much forward to chatting with you.